If you're thinking about or already are running a business, there are 5 mistakes that you don't want to make with your money. These ones are the most common and I see them all the time, especially amongst people who run businesses by themselves. So let's dive in. And if you want to see more content about financial planning for business owners, hit the subscribe button. Number 1 is mixing personal and business finances. Now you may have heard this one before, but you may not know exactly why this can not only torpedo your business finances, but also your personal finances. When most people start a business, they start a limited liability company. This actually doesn't affect anything in regards to personal taxes, business taxes, or anything like that. But what this does is it separates you personally from your business operations. It creates a layer of protection that limits your liability for the operations that your business does. Now, you may have heard the phrase piercing the corporate veil. This is when a court decides to hold a business's owner liable for something rather than the business itself. And when you mix business and personal finances, you're giving the court justification to do that because you and your business are operating as the same thing. Number 2 is neglecting an emergency fund. The issue is that most generic advice that's given on social media platforms like this one isn't really given for people with complex situations like business owners. For example, someone like Dave Ramsey, who I pick on a lot, I know, would say that someone needs about 3 to 6 months worth of expenses in order to have a fully funded emergency fund. However, with a business, you're going to need significantly more than that. The reason is that your income is going to fluctuate, and you always want to protect yourself from any business risks. Let me give you an example. Over the last couple of years, AI has completely changed the landscape for most businesses. A lot of this is positive, helping businesses accomplish things quicker and more efficiently. But for however many businesses AI has helped, there are probably equally as many businesses that AI has hurt because it's replaced a product or service that business has offered. Think about the impact that AI has had on people who run copywriting businesses. A lot of people are writing mindless AI prompts instead, which if you can't tell, I don't think is a good thing. I mean, writing YouTube scripts is a major part of my business. This is an example of why you would want your emergency fund to be bigger as a business owner than if you were somebody else. Changes in technology, the economy, business landscape, clientele, geography, even all of those things affect your pocketbook directly. So we want a buffer available so that we can address those issues if and when they arise without you having to go into a bunch of credit card debt to pay your bills. Lots of people are also confused as to what makes up an emergency fund. Well, an emergency fund needs 2 things. First, it needs to be easily accessible. You don't want money tied up in investments that you can't liquidate for 1 or 2 days at best. The second thing is that we don't want this money subject to capital risk. We don't want this in a stock portfolio or in crypto or something else because those things can lose value very, very quickly. We want this emergency fund somewhere where it's not going to lose value quickly, even if it might be over the long term losing a small amount of buying power to inflation. As of recording this, interest rates are still relatively high, which means that it's pretty easy to find a cash account and even a business cash account with an interest rate of above 4%. Now, this will change as interest rates go up and down. And if you can't find a bank account that does this for you, that would be a reason to click the second link in the description below. Number 3 is not tracking cash flow. Cash flow is quite literally the lifeblood of your business. So running a successful business without tracking your cash flow would be kind of like trying to get in shape without tracking what you're eating. It's pretty much impossible. When you aren't tracking cash flow, you're going to miss out on information that can either be signs of health that you're running a nice and healthy business, or a red flag that you need to change something. For example, on paper, you might have a month when you were supposed to make a certain amount of money, but you actually made less when you go and look at your bank account. That then might drive you to realize that one of your customers hasn't paid an invoice that's overdue. Tracking your cash flow will also help you look at your business as a whole and know how things are trending and what you should be forecasting. If you want to learn more about the do's and don'ts of cash flow, you can download my free guide, which is the first link in the description below. Number 4 is not planning for taxes. Taxes are going to be the biggest expense you have over your lifetime. And unlike people who work a 9 to 5, being a business owner means that you have a lot more tax responsibility, but also a lot more freedom in the tax decisions that you make. Make sure that you're correctly estimating your quarterly tax payments and setting aside some money into tax reserves. The last thing you want to do as a business owner is get hit with a tax bill that you had no idea was coming. Doing both of those things will make the likelihood of that happening much lower. However, you'll also want to plan for taxes that might happen several years or even several decades from now. Lots of business owners are just told to set up a SEP IRA by their accountant. And for the life of me, I cannot figure out why this is, and let me explain why. By the way, as an aside, I think that you should hire a CPA anytime that you get anywhere close to making a livable wage from your business. But SEP IRAs, while they are pretty easy to set up, are one of the most inflexible accounts that you can contribute to. There's no option to convert funds into a Roth account, and your overall contribution limits are lower than some of your other options. For example, you can set up a solo 401k, which is almost as easy as a SEP IRA to set up, and it's better in both regards. Now, not everybody is able to open a solo 401k, but I would bet that at least 80% of people who work as solo business owners would be able to contribute to a solo 401k. Rather than a SEP IRA. The reason this helps with taxes is because if you have years where you earn more or less, you can choose to either defer some of those taxes or contribute to the Roth account instead. It allows for more flexibility just depending on what your income is that year. Your business structure also has a lot to do with how you pay taxes. If you're running things as an LLC with no other special tax filings, what that means is that the LLC works as a pass-through entity. Income that's generated by the LLC is then passed through to you and you pay income taxes on it as if it were your own. An S corporation is also a pass-through entity, but you pay yourself a reasonable salary and then the rest is passed through to you as distributions. While you do have to pay income taxes on all of it, you only have to pay FICA taxes, which is Social Security and Medicare, on the reasonable salary that you pay yourself. The last option is a C corporation. C corporations suffer from double taxation because the business itself pays taxes on its income, and then when the profit is passed through to the shareholders pay taxes on that dividend as income. However, the structure does allow for more investors, so if a business is trying to raise money, a C corporation can often be a better option. And the last mistake is relying on selling your business for retirement. Here's the hard truth that most business owners don't want to accept. 80% of businesses don't sell. You might think this has something to do with narrow profit margins or messy financials, and while there is some of that, it actually goes deeper than that. Many solo businesses are not only built around a specialized product, but a person themselves. It could be a graphic designer, a plumber, a carpenter, a photographer, or yes, even a financial planner. But the issue with these businesses is that unless you train employees to do the work that you do for you, you don't really have a business to sell. You really just have a list of clients to sell. And while you might be able to sell that list of clients, you're probably not going to be getting enough from that to retire on. So if you're running a solo business or even just a business that relies on you as the face of it, you need to come up with an alternative retirement plan rather than just relying on selling it. If you see these mistakes in your own practice, hopefully you feel better equipped to address them. Or if you want to do more comprehensive financial planning, you can book a free intro meeting with me using the link in the description. And you can watch this video to learn how to build a business that still makes money while taking up less of your time.